Okay, we're going to have a look at the 2011 marginal costing question. Marginal costing is a topic which comes up very regularly on the Leaving Certificate. It's one that I'm going to speak through here now. This is a revision question for Leaving Cert students, new content for some fifth-year pupils. So the question reads as follows. Ivor Limited produces a single product. The company's profit and loss account for the year shows that during which 90,000 units were produced and sold was as follows. And it tells you the sales, which are 1,170,000, and then it also goes through the overheads, and there are 5 overheads: materials, labor, factory overheads, selling expenses, and administration expenses. The key thing with marginal costing is that we have to separate out fixed and variable overheads or expenses. And they are treated completely separately in marginal costing. So just to be clear on the definition of that, fixed overheads are things which stay the same regardless of whether this company sells 9 units or 90,000 units, whereas variable overheads will change dependent on the sales. So variable overheads could be examples like materials or like labor or perhaps like electricity. Whereas fixed overheads might be something like rent or insurance, which even if you don't produce anything, you still have to pay those fixed overheads. The sentence at the bottom of the question, underneath the information, it says the materials, direct labor, and 40% of the factory overheads are variable. Apart from sales commission of 5% on sales, the selling and administration expenses are fixed. Quite a lot of the work that we do here is preparatory work at the start, and if we get this right at the start, it'll make a lot of our part A, B, C, D, E quite easy. So therefore, the first thing we're going to do is we're going to split the overheads into a variable and a fixed total. And we can do that following that sentence underneath. It says again, and I'm going to go through it much slower this time. It says the materials and the labor and 40% of the overheads are variable costs. So therefore, that's all of the materials, 390,000, all of the direct labor, and 40% of the 82,000. Here's my 40-60 split. 40% of that are variable overheads. It also says, apart from sales commission of 5% on sales, the selling and administration expenses are fixed. So this is the variable part here. This selling expense here, that is 5% of the sales figure. And then the remainder is fixed. So therefore you take this 58,500, which is 5%, and if you take that out of the 105 in the question, you're left with 46,500 as fixed. Of course, you already have this 49,200, which is 60% of overheads, and then the administration expenses are entirely fixed. And that gives you this number here, these numbers here that I've highlighted, which are the total variable overhead and the total fixed overhead. Now that allows us to go down to the next bit of preparation work. Remember, we're still not answering the question until we get to part A at the bottom. We're going to do a marginal costing statement. Marginal costing statement is as follows. Sales, take away variable cost, gives you your contribution. Take away fixed cost, gives you your profit. So for the total here, this is quite easy. It is your sales from the question, your total variable cost up here. You subtract that to get 452,700, and then you subtract away your fixed cost of 225, and that gives you 227. It's worth noting that this 227 is the number that you already have in the question. All we have done here is rearrange the numbers, split in variable and fixed. We haven't actually changed any numbers. And then per unit, this is for 90,000 units, but of course, if we want to translate that into per unit, 1 unit, well, if you divide by 90,000, the sales are 13 euro per unit. So each thing that we are selling here, perhaps a calculator, each thing we sell for 13 euro, the variable costs are 7.97, the material, the wages, the electricity, the heating, all that kind of stuff. And that means there is a contribution of 5 euro and 3 cent from each product towards profit and towards covering fixed costs like rent and rates, insurance. So that contribution, each calculator contributes 5 euro and 3 cent towards covering fixed costs and towards profit. Now, we have to do a bit more work with this 797 because that is the variable cost, but only when the selling price is 13 euro. Remember, and I'm just going to go back up here slightly, remember that this contains 5%. This number here contains 5% of sales. So per unit, if the sale is 13 euro, then 5% of that is 65 cent. And if you take that out, the base variable cost is 7 euro 32, which is the variable cost without any 5%. That's important for later on in the question because this variable cost will fluctuate up and down as these two will go up and down together in tandem. If 13 euro goes up to 14, well, then the variable cost will go up to 8 euro and 2 cent. How do I get that? I'm just going to maybe do that out here. So if the variable cost is, if the base variable cost is 7.32, and you add on 5% of 14 euro, well, that is 70 cent. 70 cent. And when you add that on, you're going to get 8.02. It's also safe to say down here that as the selling price changes by 1 euro, the variable cost will change by 5 cent each time. That is 5% of 1 euro. So if this was to go down to 12, then that will push that variable cost down to 7.92. It'll go up and down depending on. And there's two ways of calculating that. You either take the base variable cost, what we've just done there, and we add on 5% of the new selling price, or you can just say, well, if that's gone up by €1, the other will go up by 5 cent, and vice versa, down by the relevant amounts as well. That's the full setup. Now, that allows us to motor through some of these questions now. Part A of the question. Part A of the question is usually for about 20 marks, actually, and it says to you, calculate the company's break-even point and margin of safety. Well, the break-even point, this is the formula, fixed cost divided by the CPU, and that is fixed cost of 225 divided by the contribution per unit of 503. And the break-even point is 44,871 units. That is where the company stops making a loss and begins to make a profit. Of course, we know that it had to be less than 90,000 because here is our 90,000 units and we are making a profit. So it had to be somewhere south of 90,000. In fact, it's 44,871. How safe are we from making a loss? Well, the margin of safety is sales take away break-even point, which if you go 90,000, which is what we're selling, take away our break-even point of 44,871, we have a margin of safety of 45,129 units. That's how many we could drop before we are in loss-making territory. Part B of the question asks us the number of units that must be sold in 2011 if a company is to increase its net profit by 20% over this year's number, assuming everything else remains the same. To increase the net profit, that is a target profit formula we use. So we're increasing our net profit by 20%. Well, here is our net profit, 227,000. If you multiply that by 1.2, that will bring that profit right up to 272,400. And that's the target profit that we then input into this formula, which is essentially the exact same formula, except it's the break-even formula with the target included. So how many units must we produce to not only break even, but to actually achieve a profit of 272,400. Now, if we're going to increase our profit, this answer will probably be more than 90,000 units. In fact, here it is. It is an extra 99. Sorry, it's an extra 9,026 units. 99,026 is the answer there. Interestingly, that is 10% extra units will yield you 20% extra profit, because the later units are more profitable due to economies of scale and due to the fact that our earlier units have contributed, the contribution per unit have contributed to clearing the fixed costs. Rent and rates, insurance have all been covered already. Part C of the question is underway in here. Let's just focus on this. Now, part C of the question says the company's profit, calculate the profit the company would make in 2011 if it reduced its selling price to €11, increased its fixed cost by 15,000, and increased the number of units sold to 110. So therefore, they're going to have some extra fixed costs, but they're going to sell more and cheaper. So therefore, the sales is quite easy here. It is just our new units by our new selling price will give you 1.21 million, 1,210,000. The variable cost is going to be our new units, but by a new variable cost. Now, how did we get? Well, that is the base variable cost of 732 with 5% of 11 added on. We could also say that because the selling price has gone down by €2, well, then the variable cost is going to go down by 5% of €2, which is 10 cents, and that brings that from 797 down to 787. That's where we get this number from. So there's two ways of doing the same thing there, and you can use one to cross-check the other. Then you have your 110,000 by 787, which gives you this. You take one from the other to get your contribution. Then you take away your fixed costs, which of course have increased on the original by 15,000 to go up to 240,700, and that gives you your new profit of 103,600. That is the answer, 103,600. We're going to go on to part D of the question. Part D of the question asks us, what is the selling price that must be charged in 2011 if fixed costs are to increase by 12%, but the volume of sales and profits remain the same? So if this company's insurance or if their rent goes up by 12%, they want to keep the same profit and sell the same amount of calculators. How much must they charge? Probably a bit more. Let's look at this. You set this up with your total and your per unit like we did in the original setup. You start at the bottom and we're going to work our way up because of course we're working towards the selling price. In the previous one, we started at the top and worked our way down because we were working towards profit as the answer. So we have the same profit of 227. We have a new fixed cost. It has gone up by 12%. So therefore, when you add backwards here to get the contribution, you're going to get 479,784. If we divide that by 90,000, we translate it to being a per unit figure of 533. Now here's the tricky bit. You add on the base variable cost of 732. That is the base variable cost without any 5%. I'm going to refer back to up here to the setup. This is where we got this. Why do we do that? Because we cannot include 5% of an unknown selling price. So we don't know what the selling price is yet. So therefore we add on the base variable cost without any 5%. And then working backwards, that gives us 1265. And we know that that is the selling price without any 5%. Or in other words, that is 95% of the selling price. And then you translate that on your calculator from 95%, divide by 95 and multiply by 100 up to 100%, and you see that your new selling price is €13.32. which is logically correct because it means they're selling each calculator now at an extra 32 cent on top of the price in order to cover that rise in fixed costs, but yet maintaining the same profit level and maintaining the same production level. And finally, we're on to part D. And part D says calculate the number of units that must be sold at 16 euro per unit in order to provide a profit of 10% of the sales revenue from these same units. Well, this is algebra, and we're going to have a quick look down here at this. So I'm going to say let x equal the number of units. That's our algebraic input here. And I'm going to do this really simple formula to begin with, which says, this is the marginal costing statement, except horizontal. Sales less variable cost, and then less fixed cost will give you your profit. Of course, we know that sales take away cost gives you profit. Now, what are the sales? Well, the sales are going to be 16x. We don't know exactly how many units, but we do know that x is the number of units, and we're selling them by 16. The variable cost is going to be 732 plus 5% of the new selling price, because that's your base plus 5%. Actually, I think that's going to be 732, and then 5% of that is going to be 80 cent, I think. 16 by 0.5 is 80 cent. So therefore our variable cost is actually going to be 812 here, I think, 812, which of course is 15 cent higher than the original because our sales is 3 euro higher than the original. 15 cent is 5% of the 3 euro increase. That is all multiplied by x, so it's going to be 8.12x. Our fixed costs do not change, and our profit is 1.6. Where did I get that? Well, it says in the question that the profit must be 10% of the sales, and 10% of 16 is 1.6. And then you solve that formula for x, bringing all the x's to one side, and you will get this number here, which is x is equal to 35,940 units. Of course, we always round up to the next full unit in marginal costing. Part F is a little theory part, which you can check your theory handouts on. This is a good standard question for you to practice and get a hold of before we look at some of the more complicated ones.